All right, everyone, welcome. Today, we're going to dissect one of the most foundational concepts in all of business, but it's also one that's, believe it or not, frequently misunderstood, and that's the timing of revenue and expenses. Now, I want to be clear, this isn't just about bookkeeping or ticking boxes. This is about interpreting the true economic pulse of a company. As future business leaders, your ability to make sound, strategic decisions is going to hinge on mastering the principles we're about to cover.
So let's start our lecture with a classic business problem that really gets to the heart of our topic. Imagine this. It's your new company, and on January 1st, you write a check for $12,000 to your insurance company. You look at your bank account, and yep, you're down 12 grand. So the question is, from a performance standpoint, was January a total disaster? Did you just take a massive loss? Now, if your answer is based only on the fact that cash left your account, you're practicing something we call cash accounting. And while it's simple, it can be dangerously misleading. How you should answer this question is really what separates basic bookkeeping from the sophisticated financial thinking you'll need to run a successful business. And the right answer lies in the principles we're about to unpack.
Okay, here's our game plan for today. First, we're going to define the core problem of timing itself. Then, we'll introduce the fundamental rule that solves it, which is called the matching principle. From there, we'll see this principle in action, applying it to two really key scenarios: prepaid expenses and unearned revenue. And maybe most importantly, we'll connect the dots from these accounting entries to high-level decision-making. We'll wrap up by going over some common mistakes to make sure you can avoid them in your own analysis.
So the fundamental issue we're tackling today is what we call the timing problem. You see, in business, the moment that cash changes hands often does not align with the moment economic value is actually created or used up. If we only look at the flow of cash, we can get a really distorted view of a company's health. For example, a company might look incredibly profitable in a month where it collects a lot of cash for work it hasn't done yet. A manager might see that and approve huge bonuses, right before realizing that cash actually has to cover a whole year's worth of expenses. As you can imagine, that kind of distorted view can lead to some truly disastrous decisions. This slide really presents the two fundamental ways to look at this problem. On one hand, you've got cash accounting. It's simple, right? Money in, money out. It's kind of like how you manage your personal checkbook. You record revenue when you get cash and expenses when you pay a bill. But for a business, this just isn't good enough. That's why the standard for all public companies under what we call Generally Accepted Accounting Principles, or GAAP, is accrual accounting. Now, this method is way more sophisticated. It says we record revenue when we've actually earned it, by providing a good or a service. And we record an expense when we've incurred it to generate that revenue, no matter when the cash actually moves. The whole goal here is to give a true and fair picture of a company's profitability for a specific period of time.
So how exactly does accrual accounting solve this timing problem? Well, it does it through one foundational rule that governs everything else we're about to talk about. This is the why behind the whole system. It's called the matching principle, and you can really think of it as the golden rule for measuring profitability accurately.
Okay, so here's the crucial point. For any given period, let's say the month of March, we want to look at all the revenue we generated and match it side by side against all the costs we incurred to make that specific revenue happen. The best way to think about it is like a cause and effect relationship. The sales you made are the effect, the costs of the goods you sold, the salaries of the salespeople, the advertising that drove those sales, those are the cause. The matching principle demands that we report both the cause and the effect in the very same income statement. That's how we get an honest measure of our performance.
All right, let's take this principle and apply it to our first real-world scenario, prepaid expenses. This happens all the time. It's where a company pays for something up front that it's going to use over a longer period of time. And this brings us right back to that insurance problem we started with.
So here's our problem again. The cash is gone on January 1st. But has the company received the full benefit of that $12,000 on January 1st? Well, of course not. What they've actually purchased is the right to be covered for the next 12 months. They have acquired a resource, something that has a future economic benefit. And in accounting, what do we call a resource that provides future economic benefit? We call it an asset.
Let's walk through the proper accounting treatment for this. On January 1st, we do not record an expense. Instead, on our balance sheet, we create an asset called prepaid insurance for $12,000. We've basically just traded one asset, cash, for another asset, which is the right to future insurance coverage. Then at the end of January, as part of the period-end closing process, we make what's called an adjusting entry. This is a critical, non-cash transaction that makes sure our financial statements follow the matching principle. We recognize that we've used up or consumed 1 month's worth of that insurance benefit, So we record $1,000 as insurance expense on the income statement, and we reduce our prepaid insurance asset on the balance sheet by that same $1,000. So the assets balance is now $11,000, which perfectly represents the 11 months of coverage we still have left.
And this quote right here illustrates the why perfectly. Imagine you're the manager. If your income statement showed a $12,000 expense in January, you might think the business is failing. You might raise your prices when you don't need to, or cut other costs that are actually vital. But seeing the correct $1,000 expense gives you a stable, accurate picture of your true monthly operating costs. Now you can confidently set product prices, create realistic budgets, and accurately figure out how profitable January really was. This is accounting directly informing intelligent business strategy.
Okay, so now let's flip the coin. What happens when the cash flow timing works in the opposite direction? What happens when a customer pays us before we've delivered the goods or provided the service? This is what we call unearned revenue, and it represents not an asset, but an obligation.
Think about a classic example, a gym membership. On January 1st, a customer walks in and pays $600 for a full year's access. The gym's bank account is now $600 richer. And it's incredibly tempting to look at that cash and think, great, we just made $600 in revenue. But have you really? In accounting, revenue is earned when the business has substantially completed its obligation. On day one, have you fulfilled your obligation to provide a year of service? Nope. You have an obligation that's going to take the next 12 months to fulfill.
And that brings us to the key word here, liability. When you receive that cash up front, it creates an obligation, a debt to your customer. It's a promise you now have to fulfill. Because of that, unearned revenue gets recorded on the balance sheet as a liability, right alongside things like bank loans or accounts payable. The only difference is what you owe. You owe the customer a service, just like you owe the bank cash. Both are legally enforceable obligations of the business.
This table shows the process perfectly. On January 1st, cash goes up by $600, and the liability, unearned revenue, also goes up by $600. Notice, revenue earned is zero. At the end of January, after providing 1 month of gym access, we make another adjusting entry. We recognize 1/12 of the revenue, which is $50. That $50 now appears on our income statement for January. At the same time, we reduce our liability by $50 because we've fulfilled part of our promise. So the unearned revenue balance on the balance sheet is now $550, which represents the 11 months of service we still owe.
This concept is absolutely critical for strategic decision-making. Just imagine you're the CEO of a big gym chain that sells $600,000 in annual memberships in January. If you mistakenly record that all as revenue, your January profit is going to look sky high. You might think, we're rich, let's go sign a lease on 10 new locations. But that cash has to cover your rent, your utilities, and your staff salaries for the entire year. By correctly recording it as a liability, you keep an accurate picture of your obligations and your true earned profits, which stops you from making a potentially company-ending decision based on a misleading cash balance.
Okay, so let's just pause and explicitly connect these accounting mechanics, these adjusting entries for assets and liabilities, to the world of strategic business management. Why do you, as a future marketing director or an operations manager or a CEO, need to understand this so deeply?
Look, this isn't just about passing an accounting exam. These concepts are the tools you're going to use to assess the real health and performance of any business. Understanding deferrals allows you to accurately measure profitability from one period to the next, which is essential for spotting trends. It stops you from getting a false sense of security just because you have a high cash balance. It gives you a clear view of your resources and your obligations. And ultimately, all of this information flows into every major strategic decision. Is our pricing model sustainable? Can we afford to hire new staff? Is now the right time to expand? The quality of your answers to those questions will depend entirely on the accuracy of your financial data. This is the language of business, and you need to be fluent. Now, as you're learning these concepts, it is very easy to fall into a couple of common traps. I see these mistakes semester after semester. So let's be very deliberate and break down the most common errors so you can be sure to avoid them in your analysis and, of course, in your future careers. This is by far the most frequent mistake students make when they first see a prepaid expense. The logic seems simple, right? We paid cash, so it must be an expense. But as we now know, that's a critical error in thinking. Understanding why this is wrong is essential. First and foremost, it just completely violates the matching principle. You're trying to match a 12-month expense against only 1 month of revenue. The result is a distorted financial picture that makes January look terribly unprofitable, while making February through December look artificially profitable because they'll show revenue but have no corresponding insurance expense. The correct method, as we've established, is to treat the prepayment as an asset, a resource with future value, and then to systematically expense it as that value is consumed month by month.
And on the other side of the coin, it's so tempting to see that cash hit the bank account and immediately want to count it as a win, to call it revenue. This is a very dangerous trap for any business that collects payments up front.
The reason this is wrong is because that revenue simply has not been earned yet. Remember, earning revenue requires performance. In the gym's case, it requires providing access to the facility. Until that service is rendered over time, the cash represents an obligation, not a profit. Recording it all up front creates a dangerously misleading and inflated view of the company's performance, which, as our CEO example showed, can lead to catastrophic business decisions. Remember, that cash comes with a promise. Until you fulfill that promise, it's not your revenue, it's your liability.
So if you remember only one single thing from our entire discussion today, please let it be this. Accrual accounting and the principle of deferrals are not designed to track the movement of cash. They are designed to provide an accurate picture of value creation and consumption within a specific period. It's about matching effort with accomplishment. If you can master this one idea, you will have a powerful and accurate lens through which to view the operations of any business.
And we'll end with a thought to take with you to connect what we've learned today with more advanced financial strategy. Now that you understand these fundamental rules of timing, start thinking like a CFO. How could a company, completely within legal and ethical bounds, make decisions about when to launch a major marketing campaign or how to structure subscription billing cycles to more smoothly manage its reported earnings from one quarter to the next? That's the next level of strategic financial management. Thank you for your attention.